stuff that's important, and the stuff that's important today. FOMC recap. Let's dig into it. Big moves coming off of the Fed announcement from yesterday. We're going to recap the moves, but also hopefully develop some life lessons for Fed announcements down the line, because this stuff, everybody, happens multiple times a year. And guess what? The reactions in markets, though they are unique, just like snowflakes, if you blur your eyes, they kind of look like the same thing. And so, like, at the end of the day, these FOMC announcements, they are good to look at and analyze, not only to say what happened, but what can happen in the future and how we can trade it. Errol, one of your first FOMCs, what were some of the first things that you noticed, something that piqued your interest? Because you wanted to do this segment today. You were like, Frank, you're an old man. You've seen a lot of FOMCs. Let me know what is going on here off the bat, just from what you saw. What kind of, what were you like? Oh, that looks weird. Like what made you want to analyze this further?
Just again, seeing the reaction of the announcement and just seeing what people would do right after. And then watching, like we kind of mentioned, the reaction to the reaction. I thought it was pretty interesting. We had a straight bounce right after the announcement. And then, maybe people's feelings or the positions they just put on are maybe changing in 15, 30 minutes because of what we saw happen in the last couple hours of the market after the meeting. So that's kind of what I took from it. I started seeing more people just talk about and try to break down some of the statements that the Fed would release. And I realized some people will really try and break down word for word their expression, like really trying to read their body language. So that's why I wanted to dig into it. I was like, okay, this has to be really important. If people are looking to see the comma they put or how they pause in between, if they breathing too much, too heavy or whatever. So I want to see what's going on here, Frank.
That's funny that you bring that up, because first of all, algorithms do exactly what you're saying with the statement that comes out. And for those of you out here who don't know, when FOMC hits, the Fed chairperson right now, Powell, he'll come out and say right at 1 o'clock Central Time on the Wednesday that the FOMC is happening, he'll come out and say the Fed is doing XYZ with the Fed funds rates, which is short-term rates. They did nothing. Most times, 9 times out of 10, they do nothing. But what gets parsed, like Errol is saying, is the press conference that comes 30 minutes later, where Powell is speaking, how nonchalant he seems or how stressed he seems. People kind of read into that, but also the statement that comes out, which is like, this is the Fed giving you clarity on their decision and their future decisions on down the line. Algos pick up this stuff and they parse out those words quickly and they run markets around. And that's where we see a lot of the opportunity. Now, a big change yesterday, and what we're going to break down here in the moves, was that they said they're going to hike rates. They gave further confidence. We are going to hike rates, and we're going to slowly reduce our balance sheet, which is they're long, Errol, they've bought a lot of long-term treasuries. And so what this is all to say, but without getting too deep, is that they want to move short-term rates higher. And at some point, but not immediately, they're going to hike rates before they let go some of their positions on long-term rates. And so what they're doing, in a sense, is that, and what you've seen in the action, 2-year rates go up and 10-year and 30-year rates actually kind of moving lower, because the Fed is saying we're not going to look at manipulating those rates higher until we get these short-term rates higher. And so that's some of the action that you're seeing. And you see the reaction. This is just yesterday, man. The 2-year Treasury yield goes from 1% all the way to 1.2%. You might say that doesn't seem like a lot. That is a lot. That's almost nuts. one full rate hike. It's crazy price action you're seeing here in S2Y, a great product to trade it.
Is this something, I know we don't know what's going to happen. Was a rate hike pretty predictable for short term?
Well, so this is what you get, right? Like, yes. And you can see here going into this meeting, short-term rate futures have moved way higher.
From like last week, right?
Exactly. Over the last several months, they've been predicting, the Fed is going to hike. And yesterday, even, they didn't hike. And so this is all what the rally that we saw here is, just further confidence that there's going to be more hikes down the line. And so all this stuff is really efficiently, and that's why they parse out all of this information, Errol. By the time the Fed actually hikes this year, the market might not even move because we'll already have projected that in the futures, very efficient. And you can see here the 2-year got to multi-year highs because the market is the most confident that they've been in the fact that the Fed is going to hike their Fed funds rate, and thus the 2-year yield will move higher. Now, where it gets interesting here, at least a different type of interesting, is the stock reaction. You see stocks right off of this number at 1 o'clock. The algos and everything, they're parsing this information out, and they're probably saying to themselves, okay, as they parse out all this information, oh, the Fed is feeling confident about hiking rates. That might be some confidence in the equity market. The market runs up and then immediately gets slammed.
I mean, it takes the high of day and slams.
Exactly. And so, and like you alluded to it, as people kind of they decompress and they harp on this a little bit more, what this means, it's like, oh, they're hiking rates, higher rates. Money is going to be harder to come by for some of these companies. To borrow money, it's going to be more expensive. This isn't necessarily a net good thing for stocks. And so stocks sell off big. US dollar, huge rally because the US is hiking rates, whereas in Japan and Europe and Great Britain, obviously I know England and everybody else is in Europe, but I'm talking about the Eurozone and UK they're not quite hiking rates. And so our currency appreciates relative to their currencies. And also the non-interest bearing metals, Errol, they get slammed yesterday. Gold and silver get hit real hard. They're getting hit even harder as we speak. Those are the big reactions across the markets. And then the next thing is, well, when's the next meeting? What are the expectations? And you can see here, we're right here. This is where rates are, which is 0. And what this is saying here is that the market's already projecting that rates are going to be up to 125 or 150 basis points, or 1.25% or 1.5%. And so this is all the action. The action for a lot of these FOMC events, Errol, is what's going to happen in the future. A lot of these people pricing in off of Powell's statements, what's going to happen in the future. And that's where you see some of these huge moves like you see in interest rates. But some of the most opportunistic moves are the short-term kind of like, why the heck is that doing that in stocks? And that's a little bit of a recap for your FOMC for active traders.
That was solid. One of the things you mentioned